Hey guys, welcome back to the channel. Now, if you've been watching for a while, you know that I'm a big fan of ETFs when it comes to long-term investing or exchange traded funds. Now, if you're wondering what an ETF is, I've already made a video discussing this. Just click on the link above and it'll take you straight to that. But for today's video, I actually just wanted to go over 3 ETFs that I really like. I just want to explain why, or go over why I like them and why I would invest in them for the long term. Now, as always, none of this is financial advice. You should always do your own research before you're investing your money into anything. This is all just for entertainment and educational purposes only. Now, if you're new to the channel, if you haven't already, please consider liking and subscribing to the video, to the channel. It helps out a bunch, especially with the YouTube algorithm, and it just gets the video out to other people who might be looking for the same, answers that you're looking for. So without further ado, let's get straight into today's video. Alright guys, now the first ETF that I actually want to show you is the NZ Top 50 ETF. The ticker symbol is FNZ if you're looking for this on something like Sharesies. Now this ETF, it's designed to track the S&P/NZX 50 portfolio index, which is basically just the top 50 largest companies on the NZX, right? That's essentially what it is. Now, if we scroll down here, we'll look at the fund details. So inception date is September 10, 2004. So it has been around for quite a while. And you'll see here, one of the things to look at when you're looking for an ETF is the fund charges or the expense ratio. This is 0.5, which is a little bit more expensive than you'd like. However, it is still a very good, still good compared to something like what most funds charge you for your KiwiSaver investment. Now, if you want to scroll down here, we look at the top 10 holdings of this ETF, and you'll see a lot of familiar names. You'll see Mainfreight, you got Fisher & Paykel, Spark NZ, Auckland International Airport, Fletcher Building. A lot of familiar names here if you're especially from New Zealand. So this is going to give you overall a really good exposure to the NZ market, which is still probably emerging in my opinion right now. We'll come down to the fund performance. Now, what they've got here is the 5-year annualized returns for this fund. Now, the important one we'll look at here is the investor returns. This is the returns you'll get after tax and after the fund's fees. And you'll see here 5 years annualized is 12.61%, which is really, really good returns. Especially considering something like putting your money in the bank or a savings account, you're probably getting only 0.5%, 0.1%, or if it's a fixed term deposit, maybe you'll get one a little bit more than 1%, right? But you'll see here 12.61% over a 5-year annualized period is really, really good returns. It does pay out a dividend as well. But one thing to note and to keep in mind is that don't expect this 12.61% to be the norms or to be the normal return for these types of funds. You want to be expecting long-term something a little bit more along the lines of maybe 7 to 8%, which are still very, very good returns, especially if you're leaving it in there to compound over a long period of time. So the reason why I recommend this one is so that it gives you some exposure to the New Zealand market, which is still quite young and growing in my opinion. So something like this will give you diversification and exposure to the NZ market, right? This will lead us to the next one that I really, and kind of a favorite of mine, and that is the Vanguard's VOO, which is the ticker symbol for Vanguard's S&P 500 ETF. Now, I've talked about this one. I've probably mentioned this one 100 times already on the channel. Invest in stocks in the S&P 500 index, representing 500 of the US's largest companies. So basically, this ETF is designed to just track the performance of these 500 largest companies, right? Now, again, look, it's more appropriate for long-term goals. So if you're thinking of investing only for the next 2 to 3 years, ETFs is not for you. This is for something, 20, 30 years plus, right? Now, if we scroll down a little bit lower, you're actually going to see the top 10 holdings month end, right? So this is probably the latest top 10 holdings. And you'll see a lot of familiar names, obviously Apple, Microsoft, Alphabet, Amazon, Facebook, Tesla. These are, Berkshire. These are all companies, some of the largest companies in the US. And just by buying one share of this ETF of VOO, you're going to get exposure to these top 10 companies and the rest of the companies that are obviously the other 490 companies that are in the fund, right? Now, another good thing about this ETF in particular is the expense ratio is only 0.03. Now, in a second, I will show you the impact that fees will have on your long-term performance. It's quite substantial. Before I do that, let's look into the price and performance of this fund. So now we're here, we're just gonna have a quick look at the performance of VOO in the last 10 years. And you'll quickly see here that, you know, the S&P 500, the market price, the 10-year annualized is 16.17%, right? Since inception, which is the 9th of the 7th, 2010, 16%, right? Which is really, really good returns, right? Doing 16%, you know, that's more than you can hope for. You can see here returns before taxes, in the 10-year period, 16.59%. So, you know, since inception, you're looking basically at returns of around, you know, 13% after taxes and distributions like dividends and things like that, right? Now, that's really, really good returns, especially again, if you're just leaving your money in the market to compound, right? 10 years, most individual stock pickers, most fund managers would only dream of doing, you know, 16%, 10 years, but you can get that just by leaving your money in the market, right? So that's why I always say ETFs are a great long-term vehicle for investing. But again, I do warn, that is not historically, the S&P 500 index has brought something closer to 8 to 9% or 8 to 10%, right? Historically. So don't expect 15 or 13% for the next 30 years, because that's, you know, that historically, that's just not what the data shows, right? So the expense ratio for the S&P 500 ETF is only 0.03%. The average expense ratio of similar funds is 0.82%. Right now, 0.82% still sounds pretty low, but if you scroll down a little bit further, they actually show you. So if you see here, this is a hypothetical situation, right? This is just saying, you know, if you had $10,000 investments with the annual rates of returning 9% over a 10-year period, assuming you don't add any more money to that investment and you just leave it in there for 10 years, the effects of the fees, you'll see that with the average fund, which is 0.82%, in that 10-year period, you're going to pay fees of, you know, a total of $1,871. Right now, with the expense ratio of 0.03, you're only going to be paying $71. So you actually save $1,800 just by lowering your expense ratio. You can see, obviously, you can imagine, you know, just imagine what this would be like if you're paying, you know, 1.5%, which is what most funds, or 2%, which is what a lot of funds, you know, charge these days. But that, again, guys, that's just a really quick show or the impact that a high fees can have on your returns, right? And then obviously, if this was longer than 10 years, this number would be a lot bigger, right? Now, that's the S&P 500. And the reason why I recommend this one next is because now you have exposure to your local market, the NZ market, and this will obviously give you exposure to the US market, right? So now you've got a real broad diversification. You've got New Zealand market, the US market, and obviously the next step up from that would be something like this, which is Vanguard's Total World Stock ETF. Obviously, now you want to get some kind of diversification on the global scale, right? And the ticker symbol for this is VT, right? Now, this invests in both, not only US stocks, but also foreign stocks, and it actually seeks to track the performance of the FTSE Global All Cap Index Fund, right? Which also covers both well-established and emerging markets, or still developing markets, right? Now, again, you can imagine why I would put my money into something like this, because now I've got 3 layers of diversification, basically, right? I've got the NZ market, the US market, and then you've got the obviously the global market, right? So if you really want to diversify your portfolio, and that's why I'm recommending these 3, and of course that's not financial advice, but expense ratio, again, very, very low, 0.08%. So a very, very cost-effective fund that's going to give you really, really good broad diversification, right? So if we just scroll down here, you're going to see the composition of the portfolio, right? So you see emerging markets, that's 10.5%. Europe, you're invested in Pacific, the Middle East, a big chunk of it's in North America, and you see some of the companies here, probably similar to the S&P 500 that you see, because obviously these are some of the largest companies in the world, which is why you'll see these companies mostly in the top 10. But just buying one share of VT is going to give you really, really good diversification, and it's going to give you exposure to basically, the rest of the world, right? The rest of the world market. Now, if we look at some of the returns that the VT has brought back to shareholders, we'll just come down here and we'll see here that 10-year annualized 11.68% since inception, and obviously its inception was in 2008, right? And you'll see 8.18%. An average basically around 8%, right? And you'll see here World Stock, the ETF, returns after taxes. You'll see 6.32% since inception, 10% the last 10 years annualized. So again, really, really solid returns for something where you're not really doing anything and you're not really paying, you're not really actually paying fees for it essentially. Well, you are paying fees, but very, very cheap to buy and own these funds, right? And that's why, I'm a big fan and big advocate of investing in ETFs, because, you don't really have to do anything. And already your money is compounding and it's doing a lot better for you than if it was sitting in the bank doing nothing or losing money, as most savings account would do, right? So these are 3 ETFs that I would highly recommend for you to look at. There's obviously hundreds more out there. You just got to do the research. I'm literally just on Google, and you can Google the ETF and you can find information on any ETF that you might be considering. But the most important thing is to find one that will give you diversification to a market that's a broad market diversification. So for this strategy, I've chosen, your local level, the US market, and then the global market, so that you have your stock portfolio is, basically it's as diversified as it can get, right? And all you do is just come in there and you buy it every month or every couple of months or whatever it is that you decide to buy, but be consistent and stick with it for the long term. And it can help it work out for you. Okay, so guys, let me know your thoughts down below. Is there any ETFs that you're really into at the moment? Comment down below if there's one that you'd like me to look at, or if there's any other video topics that you want me to cover. But thanks a lot for sticking around for this long. I really appreciate it. And if you enjoyed this video, click on the links on the video now. Check out the ETF video that I've already made. If you're wondering what an ETF is, I do go in depth, pretty in depth on that one. So check it out. And thanks again. We'll see you in the next one.